Hey there, tech enthusiasts. Buckle up, because today we're diving into the roller coaster ride that is Intuit's recent performance on the NASDAQ. For those of you living under a rock, Intuit is the tech giant best known for bringing you financial tools like TurboTax, QuickBooks, and Credit Karma. So what's going on in their world? Well, a lot. First off, Intuit stock took a bit of a tumble today, dropping about 7.77%, bringing the share price down to 630.62. But why the dip, you ask, especially after such seemingly solid news? Let's start with the earnings. Intuit released its Q4 financial results, which were pretty impressive. They reported a quarterly revenue of $3.18 billion, beating analyst estimates of $3.8 billion. Their adjusted earnings per share came in at $1.99, again surpassing the analyst projections of $1.84. So far, so good, right? Well, here's where it gets intriguing. Despite these robust numbers, the stock fell. One likely culprit is their forward guidance for the fiscal year 2025. Management lowered their long-term growth outlook from 8 to 12% to 6 to 10%. Talk about a mood killer. This guidance may have tempered investor enthusiasm, despite the smashing current results. Analyst reactions were mixed, but generally positive. Analysts like Brad Sills from Bank of Montreal reiterated a buy rating, upping the price target from $730 to $780. He noted that the company's small business growth exceeded expectations, and that their AI investments, like the new Gen AI tool Intuit Assist, hold promising potential for future gains. On the other hand, there were voices like Mark Murphy, who maintained a neutral gambling stance while marginally increasing the price target from $585 to $600, pointing out areas like the unexplained degradation in free cash flow margin as worth watching. Another interesting tidbit is the new $3 billion stock repurchase authorization. Share buybacks can often be a sign of a company's confidence in its future prospects and a way to return value to shareholders. So that's definitely something to keep an eye on. Let's also break down some of those sector performances. Intuit's small business and self-employed group revenues shot up by 20%, hitting $2.55 billion. Credit Karma is also doing some serious lifting, with its revenue climbing 14% to $485 million. However, there's a bit of a fly in the ointment as the consumer group revenue tumbled by 12% to $113 million. Additionally, as we look ahead to fiscal Q1 2025, the company's guidance on EPS of $2.33 to $2.38 fell short of analyst expectations of $2.79 per share. This might explain why the stock saw some immediate retreat. To wrap it up, Intuit is a fascinating case of a strong quarterly performance overshadowed by cautious future guidance, which keeps investors on their toes. Despite short-term dips, their long-term prospects powered by AI and robust growth in various business segments might still keep the bulls interested. So, if you're thinking about betting on Intuit, you'll definitely want to keep tabs on how they navigate these waters going forward. That's the lowdown on Intuit for today. Stay tuned for more tech tidbits tomorrow. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.